All right, so if you've been listening to me, I appreciate it, and thanks for watching the videos. So this is sort of a primer. I know I've put a lot of information out on StockTwits and Twitter on the international investment position of both the U.S. and China, and talked about sort of the importance. This is a video that's going to prime you on another couple of videos that I'm going to issue about the trade balance, the deficit, the mandatory spending, and how these things are all going to affect each other between these two very large countries that are potentially going to be running current account deficits in the near future and building and having export-oriented economies building surpluses against both of them, which is going to create a multipolar economic world that we're going to all be moving into. Which would be new for some of us older millennials who had grown up in a period where the U.S. was the unipolar economic power after the fall of the Soviet Union. So this is going to be a pretty quick, short readout. These are some of the things I sent to harass my congressional representatives as well as Congress people that are not even in my district, to kind of focus on some of the things that I think are extremely important to millennials going forward, especially as we go into 2020. And China's, and this is going to sort of kind of give a decent explanation as to why it's very important to understand the China's current account liberalization, which is going to take place in probably the next 6 to 8 months, where they open their capital account and attempt to position the yuan to compete against the dollar. So I'm an older millennial, and I'm extremely concerned about the widening trade deficit coupled with the widening budget deficit, and those are considered the twin deficits. I think the biggest issue millennials face in transforming the nation is an adjustment in the U.S. economy, a mild recession in 2020, which would effectively rebalance the U.S. economy via depreciation of the U.S. dollar on world markets towards faster growth in the export sector. I think in combination with a progressive consumption tax, value added, would allow the U.S. to most efficiently reduce global imbalances with the rest of the world and limit import growth while expanding U.S. exports. However, the significant growth in mandatory spending associated with demographic changes and aging of the population will limit the ability of Congress and future administrations, both Democratic or Republican, in reducing rising fiscal budget deficits. The biggest risk we face as U.S. citizens to our way of life is our ability to effectively rely on foreign savings to plug the widening trade deficit, as well as increasing the size of future fiscal deficits. I think going forward in 2020, we will need to focus on more moderate fiscal solutions as opposed to pursuing modern monetary theory. Although an argument could be made, we have relatively little choice due to mandatory spending programs for expanding the size of the fiscal deficit. But there are a number of critical risks we face going forward down this path. We are on the precipice of being able to close the trade balance and run a very small surplus due to services and energy exports. The growth in agriculture, U.S. petroleum products, liquefied natural gas, and crude oil have increased U.S. national security and given the U.S. a new bargaining tool to negotiate with foreign foes on global markets. Although I worry about the U.S. international investment position, given the relatively few options outside of significantly expanding the size of the fiscal deficit. While this is the only option and solution to both Republican and Democratic administrations over the next 5 years, we are forgetting if we close one deficit and widen another, we are effectively still accumulating a current account deficit, which will require foreign financing and foreign savings. A problem that only gets worse if we are unable to raise new sources of revenues, expand the tax base, or utilize the tax code to include a progressive value-added tax. The benefits occurring to the U.S. international investment position from a tax code incentivizing savings over consumption will be greatly beneficial. The U.S. is locked in to a head-to-head competition for global foreign savings with China from 2020 to 2030. As the U.S. deficit increases with mandatory spending, borrowing needs, and interest payments on the national debt, we will likely start to erode the positive income we generate on assets we hold abroad. The amount of payment outflows to satisfy interest obligations on the debt will most certainly increase. The biggest risk to our standard of living as U.S. citizens has finally arrived. If China intends to follow through on its 13th five-year plan to fully liberalize its capital account, global investors at some point in the very near future may finally have another large, liquid, alternative bond market. This diversification could provide other countries an alternative to expanding their holdings of US denominated assets. This will be the first year we have two superpowers running current account deficits, the US and China. We are now officially in a multipolar economic world. This has serious implications for the US Federal Reserve policy decisions and the stance on interest rates. Because we only have 225 basis points of policy easing space in the upcoming 2020 downturn, which I've predicted out for most likely either the first, second, or third quarter of 2020. The implications center on real interest rate yield differentials between the US and China's PBOC to maintain an influx and attract future foreign capital. The biggest issue is the rest of the world has built up a considerable surplus with the US. This has been accomplished on the back of US households and corporations, absorbing a disproportionate share of global imbalances. This is meant to take place because the US serves the role of the center country, acting as the largest global consumer in the largest global single market. This provides the US with considerable global leverage, which is destined to be challenged as China shifts away from export and fixed asset investment-led growth to a domestic consumption-led economy. This will potentially increase the number of countries currently running a surplus with both China and the US. These countries may now have a choice and opportunity to diversify away from US assets. As a millennial, this causes me great concern because it will severely or could severely reduce my standard of living unless the US Congress can achieve more proactive solutions. The potential for an abrupt movement out of the US dollar denominated assets by both foreign governments and foreign private savings could rapidly shift financing available to US households and corporations. The potential capital outflow could lead to a significantly weaker dollar, rising inflation, requiring higher rates and real yields to attract capital back to the US. We are at the most critical point in our history, and we need strong, competent, well-meaning global leadership willing to make sure we are able to maintain our sphere of influence in the rest of the world. In the short run, for a temporary period of time, we will have to accept some levels of managed trade. The possibility of lower interest rates, relatively low inflation, and a much larger federal balance sheet to potentially warehouse US denominated assets like treasuries, mortgage-backed securities, and also Congress will need to expand the toolkit to include corporate bonds and ETFs at some point in the near future. I am just a very concerned older millennial, and I think much less about today and much more about the global economy and how the world economy will look in 2025. We, the US, are positioned from a demographic standpoint to regain stronger growth after 2025 due to acceleration in population growth relative to our trading partners, China, Europe, and Japan. But we need to take necessary, responsible steps to reduce the fiscal deficit and raise national savings, so we are able to make the necessary spending adjustments in public infrastructure and human capital investments to raise our level of productivity. I just fear we are underestimating the challenging global economy as we near 2020. We will most certainly close our trade deficit within the next 5 years due to global rebalancing. And more importantly, China's willingness to achieve higher levels of domestic consumption. However, we do not help ourselves fully if we significantly widen the fiscal deficit, which seems unavoidable right now. At some point in time, where private and public foreign savings are going to be more costly to finance our mandatory spending programs. Social Security is headed towards a deficit in 2021. We had a surplus of only $44 billion this past year, which is significantly down from the $150 billion we ran just 10 years earlier. It's frightening when you think about it. We will need to borrow to pay for the expanding cost of mandatory spending, which will effectively crowd out any benefits going to millennials and thus raising the cost due to the pay-go style of the current system. Also, Social Security is the easiest to fix and put on a sustainable path. If we were to implement a consumption tax, it could effectively allow us to possibly, in the near future, position ourselves for a single-payer health plan, which would be most cost-effective given our demographic time bomb.